Debt. It follows you wherever you go. If your city, state, province, or country is in debt, it's still on your back. You can't escape it. And it's all because of central banks. Many assets are connected to floating rates, and that is going to eventually spell disaster since there is no possible way to withstand higher interest rates. You came here for the truth, so let me unveil that for you. Today, we're going to look at the $370 trillion elephant that's staring you in the face. Let's begin. S&P 500 companies with high variable rate debt. These companies you see on this list, which I will highlight some, I know the font is quite small, are highly affected by variable interest. And there was a period of time from 2009 up until more recently where interest rates were continuously declining. And they were remaining very low for a very long period of time. However, things have changed in the US, and there have been this general sentiment that it's good to have interest rates increase somewhat. Not too much, of course, just somewhat. And so we've seen that. Fractional, very small amounts. But of course, when we're talking about billions of dollars, even a fraction of that makes a big difference. So all of these companies here are highly affected by what's going to happen and what has happened. Just to note a few names in here: Merck, Viacom, Walt Disney, General Motors, Ford, Coca-Cola, and so on. Huge companies, right? I should also mention Apple. And we look at the percentages of variable rate bonds as a percentage of the total debt. Some of these, 27%, 10%, 26%, 23%, 21%, and so on. So these are significant amounts. We're not talking about just a small portion. So you have to remember, what controls interest rates? What controls the monetary system? And behind that, we have central banks, and then of course, the tentacles of that are the commercial banks. But of course, looking at it even more closely, you understand that they're really all one and the same. LIBOR. So important to understand this completely fixed. Admittedly, they were caught fixing LIBOR. This, I can't even think of the word. It's this scam. All right. It is still used to benchmark over $370 trillion of financial products in 5 currencies. Look around here. You can see the US dollar, the euro, British pound, yen, and so on. We're talking about a very, very significant amount of financial products that are out there relying on the LIBOR rate. And even when it was found out to be fixed by the corporations coming together and deciding what it should be and how they will adjust it up or down, none of that seemed to matter anymore. But here we are today. So the LIBOR, it's been rising. It's been rising quite a bit. And that's not a good thing for this $370 trillion. And as I said at the introduction, debt, it's always there. Now, a lot of this debt, it's connected in to variable rates. I just want to touch on a couple points from this article out of the Wall Street Journal. Small banks have been fighting for a bigger piece of the credit market in search of higher returns. Now they're contending with rising losses. Missed payments on credit cards at small banks have risen sharply over the past year, a sign that cardholders are taking on more debt than they can handle. Oops. Their charge-off rate, or the share of outstanding card balances written off as a loss after consumers failed to pay, hit 7.2% in the fourth quarter, up from 4.5% a year ago. That's practically double in 1 year. And that's a significant amount, 7.2%. We're talking about big numbers here. You know how much credit card debt there is out there, over $1 trillion worth in the US. Concerns have been mounting in the broader credit card industry about the recent trend of rising delinquencies, while overall card losses are still relatively low, not true, below the historical average for the last 30 years. For instance, they've been slowly climbing in the last 2 years. I'll show you this right here. You can see, particularly in small banks, they have been rising. Now, why small banks? Well, the bigger banks have been saying no. They're saying, we don't want you around. And that's not a good sign here. Not a good sign at all. All right, I'll move on from that. A healthy economy can be a dangerous thing. Americans have a history of loading up on debt in good times, then paying dearly when the bills come due, something I say all the time. Adding to the pain, a booming economy is often accompanied by rising interest rates, which make mortgages, credit cards, and other debt much more expensive. As the Fed raises rates, the signs that consumers are putting themselves in peril. When consumers are confident or overconfident, when they get into the credit card trouble. Okay, it goes on to talk about the debt situation. People will always get into more debt. They're never going to learn. It's a simple matter of fact. And those retail investors that are basically the minnows around the big fish, they've been chasing this rising up and up and up and up. Okay, and we've been seeing all of this happening. Now, all that debt, all the margin that people have been using on their stocks, on their other so-called investments, this is not going to be a good thing because of what we can see here. All of this is adding up, and that's not a good sign, okay? Not a good sign. I'm showing you the things that are not good signs. What about this? McDonald's. They were told, corporate-owned stores in the US, they were going to get $1 an hour above the local minimum wage. Some workers say that the fast food giant hasn't kept pace with the times. They will do whatever they want. All they need to do is basically issue a statement, say we're going to do this, and everyone's going to forget about it. That's just the way it is. They'll ignore it. There's so many things coming in and out of the news. They do things like this as propaganda. They want people to think, oh, this is a good company. People are going to get paid more. Okay, the stock, let's push some more money into the stock. Let's try to get the pension funds in there. Let's try to get all of that happening. All right. You know what the deal is. Now, I want to switch gears. Going back to the issue of central banks. Understand that central banks out there exist to print money and manipulate interest rates. This is all they do. They can't benefit the economy. They're not transparent at all. They will screw everything up if it means protecting who they are. Basically, they're all part of this commercial banks and government individuals and so-called deep state or whatever. So look at this. This is the Swiss National Bank, all right? This is their US stock portfolio. Whether it's Apple, look how many shares they own. Nearly 20 million shares. Billions of dollars worth in this list. And they own, look at the FANG stocks here. Right? The FANG Plus, maybe we'll call it. Google. Everything. And haven't those been the best performers? Do you think so? of course. The best performing stocks, the biggest and best, are all being purchased by the central banks. They print money and they buy shares. Look at this. Outperforming the FANG, plus their own portfolios doing so well, incredibly well. They have been outperforming everything. The Swiss National Bank is just a hedge fund. They will always continue to do well because they have a printing press. Here you could see it again. Taking a look at this. They can't lose. And these central banks collude together with the commercial banks, because of course they're all one and the same, with the politicians, with those connected at the highest levels. And they decide how things are going to be. They are not going to ever lose. They are the ones making the decisions and calling the shots. That's all for this video. If you found it informative, please give me a thumbs up. When you give me a thumbs up, it helps to support this channel. So I do appreciate that very much. And last but not least, if you found this video informative, I know that you will find my books, The Money GPS, and my newer release, Global Economic Collapse, even more informative. You can actually flip through these books. All you need to do is go to Amazon. The links are in the description below. Click there. It'll bring you over where you can actually look through the pages of the book to see if you like them. Take care.